Hi everyone, Jeff Yasteen here. In my experience, here's investors' biggest bear market mistake. It's listening to everyone else, the CNBC talking heads, strategists, the Wall Street traders, the financial commentariat, if you will, everybody who tends to predict the length, breadth, and severity of bear markets on TV or on the internet. It's the perfect recipe, in my opinion, for not making money ever. You'll stay out of the market far too long until it seems far too late to buy back in. So take it from me. This is not my first rodeo on this. This is basically my fifth bear or near bear market that I've experienced in the last 30 years of investing. And as we look at this chart of the S&P 500, the problem is assuming that the ups and downs of the S&P 500 index in a bear market automatically match up to the individual stocks that you might want to buy. Often the best quality stocks attract large buyers as they fall and so become deeply undervalued faster than the index itself. So their shares tend to bottom first, even as the broader market continues to head lower. Weeks or months later, someone on Wall Street will raise a green flag and say it's safe to get back into the market. But when you suddenly decide to start shopping for stocks again, you'll find that a lot of the best ones are no longer the great bargains that they were only weeks or months earlier. TJX companies, the symbol is TJX, is a good example of this principle and this observation in action. Like virtually every other stock in the S&P 500, the shares are down 45 to 50% just in a matter of weeks as investors braced for COVID-19's impact, and last week they got it. TJX said it was closing all of its stores for 2 weeks, including its e-commerce operations, as well as withdrawing its first quarter and 2021 earnings forecast. And all that's understandable. It's impossible to predict the environment in a situation like now. What's interesting, though, is the value of the stock at these levels. Over the last 12 months, TJX earned $267 a share in profits. Now, Wall Street typically assigns a PE value of 20 to 22 to own the stock. In other words, traders will pay up to 20 times its 12 months worth of profits in order to buy the shares. Yet, if we divide the recent $36 stock price by those trailing results, we get a PE ratio of 13. Now, the last time that TJX traded at a PE level of that level or lower was in the last waning days of the financial crisis. And this accompanying chart from 2008 shows how TJX stock bottomed months before the S&P 500 did. It took the express train to larger profits, larger gains, long before the index finished its decline and started to chug out of the station. So, in retrospect here, yes, the impact of COVID-19's environment here makes it hard for retailers and for Wall Street to forecast what the revenue and earnings will be or what the impact will be. Yet, that's the whole reason why you focus on quality names at a time like this, because they have a history of doing well in the past and will likely do very well indeed in the future. Something to keep in mind as we move forward here. Make sure to continue to watch for my material and my social media observations and to subscribe to my YouTube channel. I'm Jeff Yasteen, wishing you the best of goodbyes.